Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
Hey, if you're not hitting us up on YouTube yet, please do. You can just search DIY Money on YouTube. You'll see our beautiful faces, and we've got some shorts, whatever that is. I don't know, little snippets or something. Instagram, DIY Money Podcast. The Tribe in Facebook, DIY Money. All sorts of good stuff happening out there. I podcast a couple weeks ago. I was like, "Yeah, hit us up on the blog. We got all sorts of blog pieces. We have no new content up there.
We got to work.
We're gonna work on that slowly but surely. But again, we are going to be getting back to questions. So if you've been new to the show and you've loved the content, that's wonderful. But we will go back to audio questions shortly. So send us those audio files. Hop on your phone, hit record, send us a question. Email that to podcast@DIYmoney.org. That's podcast@DIYmoney.org. If we use it on the show, we'll give you a $25 Amazon gift card. It is a very, very simple process. I want to give a shout out to our sponsor, our primary sponsor, Jewel Financial. We still are fiduciary advisors. We work in that business every day. If you have a complex situation, need a second opinion, hit us up on a web, Jewel, Joule, financial.com. Maybe reach out. We'd love to have a meeting, learn about your situation. If we can help you, great. What are we talking about today, Logan? This is a unique kind of episode in that we're transitioning from more of the psychological, like the last show, which I absolutely loved, is kind of who was in on our journey with us and so forth. And now we're going to move more to the practical, the actual application of things.
That's right. So we've talked for the last 6-7 episodes about how to get your financial house in order, how to follow the DIY money steps, get your emergency fund, pay off debt. We've walked through all these different things. We haven't talked about investments, which is what we do every day, right? So we're going to talk about getting started in the investment world. It is hugely important, and you need to keep it simple. I mean, there are so many people out there that make this so complex, and they try to do all these different things. You just need to get started, for one, and then number two, keep it very simple and keep it easy. So we're going to start with the very fundamental basics. How do you start investing? How do you start saving? Number one, I'm going to let you speak a little bit to this. Utilize the resources that are probably already in your life, and that starts with the 401k, 403b, an employee retirement plan through your employer that you can go in and you can put money and start saving on a paycheck-to-paycheck basis.
I tell kids at the university there's two non-negotiables, in my opinion, when you're looking for a job or a career. One is a health insurance plan, and the other is a retirement plan, preferably with a match. And so I tell them those are the two non-negotiables, in my opinion. If you are looking for a reputable career or business and they don't have those two things, it's a non-starter. It's not even, you look elsewhere. And the reason is because when you're young and starting out, obviously you relatively most of the time have good health, but you're going to cover any unforeseen issues. So health insurance, obviously critically important. But the second thing is you'll never get that time back from an investment standpoint. And if you have ever read the DIY Money book or understand the DIY Money steps, there's an interesting caveat, and I want to make clear right now that even though you might have credit card debt, student loan debt, auto debt, and no emergency fund, and you want to get the fast cash going and all those things, when you are offered a match, that is step number one. And the reason that is step number one is that is free money. Like, if you get a company match, dollar for dollar match, or a 50-cent match up to a certain dollar, or whatever it might be, and you don't take it, you are literally driving to work every day or walking through the parking lot, looking down, and there's money, not fake money with some weird advertisement on the back, real money that you're just walking by and going, I'm too lazy to pick it up.
And it's crazy to me because we talk about return all the time. People talk about return on investment all the time in everything. That is the highest return on investment you can get anywhere.
Yeah, it's 100%.
It's 100%.
Yeah,
it's 100%
the minute you put
return.
money in, they're matching it, and it's 100% return. It's actually, not to jump back to psychology, but it actually becomes one of the psychological kind of warm and fuzzy blankets that we get while we're investing and working that is just like shred off of us when we retire, because no longer are you getting that match, no longer are you contributing or dollar cost averaging. Whole nother conversation for another day. But what we really want to talk about today is outside of that.
Right.
So you will not believe the number of people that I meet that have been faithful, investors, disciplined savers their entire life, and yet when I talk to them about anything outside of a 401k or 403b, they're like, "Well, what do you mean?"
Yeah.
Like, no, we just
have a
build
bank
up a
account.
savings
Yeah,
account,
right.
and thank goodness it's now paying us money. And I'm like, what? Like, are you kidding me? And the reason I say that is that the retirement account, a company sponsored retirement account, is like baby step number 1. Baby step number 2, I would say, would be an ancillary retirement account, such as a Roth and a traditional. Now, there's nuanced rules and regulations whether you can contribute or not to that, which we've covered in podcasts galore, or you can Google or ChatGPT or Grok or whatever, okay? Real simple stuff.
I would say an HSA falls in that category too as well.
Absolutely. HSA falls in that category. But what we're specifically talking about today is opening another account, much like a savings account, that's a traditional investment account. Often, and all these words are synonymous: brokerage, taxable, investment, individual account, joint account, my Schwab account, my Fidelity account. Okay, these are all synonymous. All they refer to is another investment account that's not retirement, that you can invest in, you can put money in, and you can invest and buy anything from mutual funds to individual stocks to bonds to CDs to whatever, or leave it in cash. But the barriers to entry these days are zero. Zero.
Lowest they've ever been.
When I was in college, I opened an E-Trade account. I had to have, I think it was $3,000 or $5,000 to do it. As a college kid, I was like, this is ridiculous, okay? But I scraped it together because I really wanted to buy stocks. This is in the 90s, and I was like, I got to get my stock account going. And I was no longer at home, buying through my father in the account that I never really ever saw. It was kind of fugazi out there. But I got my E-Trade account, right? And I opened it with my $5,000. And I had to buy 100 shares. And it was like $29.95 to buy the 100 shares. It was ridiculous, okay? Now, thankfully, it was the 90s. You could buy a stock for $30. You make a couple hundred in a few hours, sell it immediately. I was a genius. Like, why even go to class? Nowadays, okay, you can open a Robinhood account on your phone in probably a minute, have no, deposit required, no minimum. Maybe they're like, oh, put in $10, we'll match you with 2, or I don't know what they do. They incentivize you to get started. You can buy fractional shares. You can buy, there's no what's called round lots. You don't have to buy 100 shares. You can buy the mutual funds. It's unbelievable how limited the barriers to entry are. Now, it does open Pandora's box, however.
Of course.
So let's speak to that a little bit about keeping it simple and so forth.
Yeah, so I've had a lot of people that have been like, oh yeah, I opened my stock account and I started throwing stocks in there and I'm playing the stocks. Okay, when I hear that, what I hear is I opened up another thing that's right next to my FanDuel or my DraftKings account, and it's the next app over, and I started throwing things in there and trying to make some money, right? What we're talking about is having a disciplined approach, putting this in your brokerage joint account that you're going to be investing in for long term. It might not be as long term as retirement, but you're investing in these things for longer term goals. Remember, we say this all the time on this podcast, 5 years or less, don't invest. So what we're talking about when you're putting money into a brokerage account is not, hey, I'm going to make a quick buck and then I'm going to flip this and I'm going to buy something else and I'm going to flip that and my $100 is going to turn into $200 and now I have that. No, we're talking about disciplined investment. How do we do that?
So even though I talk about Robinhood, okay, I would 100% agree with you that, and in their attempt, listen, they're rapidly growing, they're very popular, but you're right in that it's right next to the DraftKings, FanDuel, etc. In my personal opinion, you keep it boring.
Yep.
And that's why I personally, no affiliation, would probably recommend a Vanguard, a Fidelity. We use Charles Schwab for us, but doesn't, an institution like that where it's kind of out of sight, out of mind. And you're opening the account. If you're married, it's a joint account. If it's just individual, etc. And you're starting a systematic program, just like you're doing with your 401k, where you're taking a monthly amount and you're dollar cost averaging into an index fund.
Yeah.
And as you begin, I'd probably just use the total market index. I mean, Fidelity, for instance, has the ability to own the Fidelity Total Market Index. There's no fee to open a Fidelity account. There's no fee to keep it open. There's no fee to buy anything. And oh, by the way, you can buy this Fidelity Total Stock Market Index Fund for no fees.
Yes, right.
It's unbelievable.
And let's break down the jargon a little bit for those that have no idea what we're talking about. When we're talking about an index fund, that's tracking a basket of stocks. So when we're talking about the broad market, it's tracking the whole market.
It's
tracking
5,000 stocks.
Exactly.
I think it
all
tracks
these stocks.
I think it tracks the Wilshire 5,000, which is 5,000 publicly traded companies.
Or the S&P 500 that we talk about all the time, 500 of the largest companies in the United States.
Yes.
So you're talking your Apples, your Amazons, your Googles.
Now, you might be very comfortable with what we've talked about on this show a lot called target date funds. Maybe you have one in your retirement account, and you're like, no, I like the idea of a target date fund. For more information, just look that up. Well, then use a target date fund. But what we're talking about in this instance is an account that you're setting up that allows you to dollar cost average into a passive investment. You're not trying to time the market. You're not getting a feeling for this or that, whatever, blah, blah, blah. And you're ultimately putting it on rinse and repeat, so you now have another pool of money that may be available to you prior to retirement that allows you to retire early. Or you're like, in 10 years, I need to maybe we're going to buy a new house. Maybe we're going to, whatever. 5 years or less, don't invest. 10 years, 6 years, 7, 8 years, start investing. But it's another methodology, another vehicle by which to do that. Now, I will take a different track down the Robinhood. You want to put it next to FanDuel and DraftKings and buy some stock and do it? You should. God bless you. Okay, this is after you've put the money in and your dollar cost averaging into the passive index fund. But if you got a hankering, if you're like, what, Nvidia's come down and it's below $100, this is the greatest buy since sliced cheese. I should buy some Nvidia. Open a Robinhood account and buy some Nvidia. And the reason I'm even saying that is twofold. Number one, maybe you're right and it becomes the greatest investment in the world. More than likely, you're going to learn very quickly how risky and how dangerous and how expensive it can be to be wrong with individual stocks. And how much time. You might make a quick buck in the beginning. You might even be right buying NVIDIA under 100 and all the rest of that. But as time goes on, you're probably going to learn, like the countless people we've encountered over the years that go, I'm not doing this. I don't have the time to do this. I don't have the energy to do this. And sometimes we see portfolios. Somebody came in, they bought two stocks, right? We bought Microsoft and Google 20 years ago, and we're like, holy cow, that's unbelievable. And then they also have 15 companies that went bankrupt. And you're like, well, what about these? Yes, those didn't work out so well. So we stare at the Microsoft and Google that were amazing. We think they're a genius. But the reality is the portfolio hasn't made any money. So and those people ultimately are like, we're not dealing with this. You do it. I don't want to deal with it, etc. So I'm not opposed to that. I'm not opposed to that as far as a Robinhood account next to your FanDuel or your DraftKings and you're buying stocks and you're doing that. I am not opposed to that at all. But that's not what we're referring to. We're referring to a systematic investment account that you would open to supplement your retirement in the future. This is the same methodology that you would use to open a custodial account for a child if you were looking at investing for their future instead of, say, a 529 or something of the like.
Last thing I'm going to say on this is we had that whole Money Pit series, and that was all about discipline. The Money Map series is all about intentionality. It's all about making sure that you're intentional with the people that you're putting around you as mentors. In this space, when we're talking about investments, it's the intentionality of what your goals are in the future. So when you're setting up a brokerage account like this, you should have some relative idea of what that money is going in there. If you're going to be putting $100 a week into an account like this, okay, that is probably for the goal of buying a house, our dream home that we're going to be buying and having a down payment for that, or being able to pay cash for it. Or we're putting money into this account to supplement early retirement, or we're saving for our kids. Whatever that is, that's really important when you're setting these accounts up, because what happens is if you just start throwing money into an account, even if you're buying index funds and you're just throwing money in there, the first time we have a decline, you're going to feel your risk tolerance. You're going to feel that scared, worried, oh gosh, I should just take this money out. And you're going to probably make a bad decision. But if you have that goal in mind, hey, we're going to buy a house in 10 years, and in year 3, the market's down, well, we got 7 years for this to recover before we need it for our long-term goal. So having the intentionality of when I'm setting up this account, when I'm putting money into it, I have a goal in mind is huge.
Yeah, and even if you don't necessarily know what that is, again, my firm belief is, let's say to the person who's crossed all the T's and dotted all the I's, you have the emergency fund, you have the fast cash, you're doing the 10%, you're living off 10, 10, 80, you're doing all the things, and you have excess margin. Well, instead of the excess margin building up the savings account, you should be building up a supplemental investment account for the future. And so that goal might just be, this is going to offset any retirement expense. This might be our vacation fund while we go off, into the sunset, whatever it might be. But I believe all dollars should have a home. I really believe that. And if you have been disciplined enough to find the home to which you've paid down the debt, done all the different things, etc., then the final home for the money, in my opinion, should be an investment account, a long-term investment account. And you know what? At the end of the day, maybe you just leave it to the kids, or it goes to charity, or whatever it might be. But it's an intentional investment account that can grow over time and to help reach those goals.
I love it.
Excellent. Let's conclude with that. All right, remember, friends, the secret to wealth is pretty simple. Live on less than you make. Invest the rest, for goodness sakes, and do so for a long, long time. Make it a great one.